Egyptian fabric factory financial analysis. In the previous video, we do a lot of demand forecasting and we can make estimation for the visibility study for a certain factory. Today, I bring for you an Egyptian fabric factory and we want to calculate its financial viability. So to start the financial viability, we need to have data from the marketing study looking for the demand forecasting. Based on the following technical and financial assumption for this project, we need to perform the financial study. So as we has been given this data, the benchmark in the market is 5,000. So this is what we call the consumptions or the actual supply in the market. Further, we have a total population of 10,500. This is the second requirement. After that, we will figure out that not all the 10,500 is looking for my product. I have only a certain 25%. So I will take only 25% out of. So I will calculate the 2,625 by doing the 10,500 times 25%. And then what I will receive, and then I will determine or I receive the 2,625. And this is represent the target population. Okay. I need to know how much of growth rate. In this place or in this location, we have a growth rate of 4%. So based on this secondary data, so this is what represent my secondary data, and I got it from a report, I find that it is only 4%. So I have all the data that can help me to find the ACP, average consumption per capita. So to calculate the ACP, we know that the ACP is basically how much it is. It is the consumption that I have it over the 2,625. So I will take the 5,000, the 5K, or the 5,000, divided by the 2,625. So approximately each of these persons are here in this place are going to consume around 1.9. So we will assume it will be 2. We approximate it up, and then we need to calculate the new demand. So since we know the formula, it is the demand over the target population, and my target population 2,625. So I need to find the new population. How to find the new population? So the new population, I will take the old population times 1.04. Then it will give me the new population. By using this new population, and I multiply it times 2, so it will be 2 times the new population 2730, then it will give me the new demand, which is 5,460. So assume, let's say, that your capacity in this place that you can produce 6,000. And the actual demand, the needed demand here is how much? It is 5,460. So which one I'm going to do my estimation? So if I will do my estimation based on the 6,000, then I will have overcapacity, oversupply. But we calculated based on the 5,460 to see how much of profit we are going to achieve. Or you are going to use the 6,000 as a whole for doing the financial analysis. So we will basically start by the 5,460 because this is the amount of number of units that we are assured that we are going to have them in real life, and we need to do the 3 scenarios that we have. So after we got this 5,460, we can do the number of units according to the product mix we have. We have here boys wear, kids wear, men's wear, and then we need to look for the total amount of units per each one. So giving this same data, then the men wear here, which is, it is typo here, it is ME or MW, men wear. So I have 20%, 60%. And how I can do this demand forecasting, I can use the very simple approach where we're going to use the full capacity. What is the full capacity? This is the 5,000. So to find the average, which is a risky place full of competitors, and this has been given in the marketing study. So it is only risky project. So the risky project, how we can determine it, then we will do for the average scenario, the full capacity, which is the 5,460 times 50%, it will give me us 2,730. Perfect. I will do the same for the worst. And what is the worst? The worst is simply that 5,460 times the 25%. Brilliant. then it will give me the 1365. Perfect. So I did both of them, and I know the demand forecasting for the worst case scenario where I receive only 25 people are going to buy from the 5460. يعني التوتال اللي موجود عندي 5460 وانا بس هستهلك كام؟ 1365. Perfect. طيب this totals that I have it and I calculated according that this project is risky. Why it is risky? We can use portal model. We can see if it is attractive or not. We can use the SWOT analysis, but here it is risky. So we have a lot of competitors. And by using many competitors, then I can know that my project is risky. Type this 1365. How can I split it? I split this 135, 60% of this 1365 to menswear, 1065, 20% for boys wear, and so on for the kids wear. I will do the same for the average. The 2730, I will multiply times 60, which is given according to the questionnaire. So this three data or three given data, this has been done through what we call it primary survey. What do you mean primary survey? Primary research, how people are behaving and how they are looking for certain products. So here I have the 546, 20%, 20%, and then 60%. I do the same for that last one. So the 5,460 times 60, and then times 20, and then finally times 20. So this is basically the demand forecasting that we're going to start our all financial analysis with it. After that, we look for the second requirement, which is we need to look for the total investment. But the first item in the total investment here is the fixed investment in the machines and assets and equipment. So I have a building which is 1 million. I have a factory which is 1 million. So I prepare the values here. I have also a machine, but here the machines is imported, let's say, for example, and this is called two imported machines. And at that time, the currency is $18. $1, 18 Egyptian pounds. So we'll transfer the whole data to Egyptian pounds. So the data for the machines, it is calculated and then multiply times 18. Then you will find here that you calculate the two machines and then you transfer it to Egyptian pound and it gives you the total value of machines, which is 1,355,580. What else we have? So we did this one, which is the 1 million and the other 1 million, and we did the machines, and this is the other machines, and this is the currency. So I have to follow all the givens data. And finally, I have furniture, and this furniture is total amount is 1,442. When we add all of these, the additions of all of this is going to give us what? 3,500,000. So 3 million and a half is the total fixed asset. So we need to know the depreciation, and the depreciation rate here for these items is 10%, 15%, 15%, 50%. We calculate the depreciation, multiplying times the percentage times the value. It's the direct way of depreciation. Then you have the amount over depreciation. After we figure out the amount of depreciation that we have it here, we sum them, and then it's give us 375,000. Come to me the amortization. And what is the amortizations goes for? The amortizations goes for the intangible asset, which is the goodwill, the brands, the know-how, all these things. So this is called the intangibles. And this is only in the case of branding. And usually if I have a brand, I will use it. If I don't have a brand, I will not use it. For simplicity, we assume it is 10%. So in this data, this is a new project. We have a lot of competitors. We don't have that brand in this project. So there is no amortization. So the total for the fixed assets is 3 million and a half. The depreciation is 375 and no amortization. After that, we go for the second step, which is the pre-opening expenses. What is the pre-opening expenses? The expenses that I will be in need for when I'm trying to find out the starting of my business. So how can I start my business? I need to look for this one. So what is the first item here? I have here only 150,000, which is representing what? Training. So the training is 150,000. What else? I have other pre-opening for the, let's say, for example, the other pre-opening for promotions, advertisement, facilities, all these things. In addition to the engineering and drawing, and this is the engineering and drawing, commercial registration, which is the 25,441. And then we add here a 1% of a fixed assets contingency. We have a 1% a backup, and this is the backup stage. And the backup stage means that I have to avoid any increase in prices. So I keep 1% of the fixed asset. What do you mean by 1% of the fixed assets? I know that the fixed assets is 3,500,000. Okay, 3 million. And then I will multiply them times the 1%, then it will give me 35,000. So this is for the contingency or the risk factor or any changes in what we call it, any change in the price. So basically, I did the total calculations for the 35,000 risk, and this is for the pre-opening expenses. So it is important to calculate the pre-opening expenses. Follow after that, we're going to look for the rest of the case. We know that pre-opening expenses, we calculate all the data, we have all the analysis, then we are going to proceed for the next step. What is my next step? I need to find the working capital. But to find the working capital, I need to a lot of preparation. What is the preparation I needed? I need to find the total sales for accounts receivable. I need to find the total cost. I need to find the COGS in order to find the working capital. So we prepare the data. So what is the first strategy we are going to start with? We are looking for the total sales. What is the total sales? Revenue analysis. And here, when I try to make pricing, I will use the minimum pricing in order to penetrate the market. So I gather different types of data for the prices on average for the total amount, so number of units, and this is prices are given like here, and it is different type of price. We have very, very high prices, average prices, high prices, average prices, and the lowest price. But based on this strategy, I will use only the minimum price. What is my minimum price? I'm going to use these prices because this is the minimum between the different surveys that I have. I have 1,000, 1,200, 1,300. So the minimum prices I'm going to use. Since I know that the total sales is the price, top price that I have it, times the units. What is the price? This is the given price. So let's say, for example, if I stop here and go back again to the prices, so I will use this 1,000 times the 273. From where I got this 273, this is the units in the demand forecasting table. So it is a price times units. It will give me the first data. I will do the same. So this is 1,000. If I go to the 1,000, the second prices, it will be 1,200 times 273. So this is the second type of the kids wear, and I will do the same for the menswear. And then I have the 3 products as you see here, and then I will do the same for the second product. So this is 1,000 times the 273, 1,200 times 273, and finally the rest of the product that I have it, I will multiply times 1,300. Then I receive here, then I will have all the data that we have it here, and this is called the total sales. This is my total sales for the worst case, the total sales for the average, the total sales for the best. So this is very nice. Okay, then he said to me a very important point. This product have a rejected items. What do you mean by rejected items? That I have a 1% rejections of items. What is the rejections of item? It is item that is returned. So I didn't receive its money. So the rejected items here is a 1%. So this 1% out of the 1,600,000. So after I did all these sales, I have to subtract, deduct from this total sales, this rejected items, and then I have the net sales, the net cash I have it, or the net amount of money, or the net values of sales that I received from this transaction. Brilliant. And then I complete the same way, the price times the units, price times the units, I add them, subtract the rejected items, and finally, we will have the net sales. Perfect. After that, we will do the same step, but for the raw material. So for the raw material, he give me the cost for the raw material is 300. I will do the 300 times the 273 and the 250, 2 times the 273, and then the amount of manware, which is here 100 pounds, times the 81,900 is give me the total of the raw materials for the summation for the total raw material data. And I will do the same for the average and for the best case scenario. So I prepared the raw material data. Let's go for the direct labor. And here we have around of 50 workers for production, and each one of them is receiving a 1,000 Egyptian pound. And then this Egyptian pounds, it is in per month. So if we go for the calculation of the production, then it will be, I have 50 workers, and this 50 workers time each one will take 1,000, and this 1,000 times 12 months, and then I will have the 600,000 for the what we see for the production. This is called for the production. I will do the same for the cleaning, and for the cleaning we have here 10 workers, and each will take 500, let's say, for example, 500. And this 500 I multiply times 12, then it will give me 60,000, and this is 6,000 for the cleaning. After that, when we calculate the 60K, in addition to that, the 600K, so we are going to add over it a 10% from the total amount, which is, let's say, for example, 660, plus what? Plus 5% incentive from the 660, the total of the 5%. Then we will receive the total payroll and the total amount of wages for here for these workers. So they are all the same. There is nothing change. مش هشغل شوية ناس وخلي ناس تانية ما تشتغلش. No. يبقى كده هنا أنا عندي ال total direct labor cost that I received here from the given data for the factory that I'm working on. Social security is because they are working informal, giving 5% for incentive of people and so on. So if we add both of the raw material and the direct labor, then we receive the COGS, and this is the cost of goods sold, which is the second or the most important second item. It is recorded in the pro forma income statement as we're going to prepare it in the income statement. Let's go to the overhead and the indirect cost, and we have here as well labor, and this labor is indirect salaries, and this indirect salaries for the wages and the workers. And here the workers that we have, it is 100,000. And I will add over 10% for social securities and 5%, then it will end up by 115. How we got this? We simply take the 100K times, as we did before, 1.15. So we will receive that 115. So this is for the indirect salary. For the maintenance, he said that 5% of the 3,500,000 times what? He said it will be times 0.5%. Then we will have the 17,500. He said that we have administrative expenses from the total sales. So I will return back to the total sales table, 1% times a total sales. So you see here that the total sales in each item is different. They are not the same. So this 1% of the total sales, as you see, it is different from each average and worst because the number of units are different. The promotion as well are the same, 1% from the total sales, not from the total sales, not from the net sales, not from the net sales. Okay. Electricity, we have two types of electricity here. 45,000, which is affected by the capacity working. If I use full electricity, it is different than working with a 50%. So here it is 45,000, which is the full capacity, 45,000. And then it is 22,500. And then it is 11,250. So here it is rated and it is different. While in the water supply and the electricity and other utilities, other items, we have a different types, which is 15K, 15K, 15K. Let's go for the planet insurance and rent, which is constant. So the planet insurance and rent is constant. So it is 50, 60 constant amount of money. And then finally, the contingency, it's a 1% for avoiding any risk. And then we add the depreciation for the total. Then we end up by the overhead expenses. This is brilliant because when we calculate all these overhead expenses, we're almost done. Why? Because we have all the data that we can help us to calculate the working capital, because I have some items on cash and other items on credit. So the account receivable is as follows. We will see. To find the working capital, we need to know the assumptions of how many numbers of facilities or how many numbers of months or how many numbers of days we buy or sells the product. So for the account receivable, he said here, if you go for this detailed instructions for the data of the account receivable, accounts payable. So he said here 3 months of accounts payable. So this here is the 3 months of account payable. And as well, he said 1 month of account receivable from the total sales. And then he said 2 months of raw material to be kept on inventory. And we have here, are the assumptions. So 2 months for raw material, 1 month of final product based on the COGS. So if I want to calculate the account receivable, we know that the average collection period, it is the account receivable divided by average sales. So to know that I am giving 1 month, so this is the 1 month so that I have it, just 1 month. So I need to find the account receivable, which is divided the average sales. So this is the 1 month times the average sales. I have the data for the average sales. So 1 month times the average sales, it gives me the account receivable as you see here. So you need to go back for the sales, total sales, as it is clear here. And then you divide it by the 12. And it's giving you average sales. 1 month equal account receivable divided average sales. Then you finish here the account receivable. Let's go for the account payable. He said that average payment period is 3 months for simplicity. So average payment period is going to be calculated by average purchases, and I'm buying only the raw material here. So account payable divided the average raw material. So the 3 months divided times the average raw material, they give me the accounts payable. So don't forget that the account payable, we are subtracting the accounts payable. By subtracting the accounts payable, so here you will have the net or the total working capital that you have it from adding all the account receivable, inventory, raw material, minus the account payment, then you have the total working capital. And this is the one we are looking for and we are preparing our data for. So what is left? What is left? It is left for me to find what we know it is a production stage. And in the production stage, we have account receivable, and I need the material. In the production stage, we have inventory of raw material. Where is my inventory of raw material? My inventory of raw material is depending on 2 months here of production. So I go every 2 months to buy the production. So what is my coefficient? It is 6. So how can I got this? So 12 divided by this 2, it gives me the 6. And this is the inventory of raw material. So the inventory of raw material is the total raw material divided the coefficient. So I got the total raw material and then I divided by 6, it will give me, let's say, the amount of inventory raw material. So what is the raw material? I return back to the table, got the data and divided by the coefficients. And then this is what we call it, inventory of raw material. What else we have? He said 1 month of supply of COGS. So it is the same. So if I look here, I will take the COGS divided 12 because I have stock for just 1 month. So I take the total of the COGS divided by 12. And then I calculate the total working capital for my production. And if I don't have a production, then I will not have inventory of raw material, inventory of finished goods. If I'm working on cash base, this means that I don't have account receivable and account payable. This is brilliant because I did the total investment. So basically we have 3 million and half, it is fixed, pre-opening 250, working capital 680, and I got the 618 of the better case, the full capacity. And then I will prepare the statements for myself. But before I work for the statement, I need to find the total investment. What is my total investment for this project? 4,368,350. And here I will be able to take a loan of 3 million and a half, and I have a capital of 868. So again, this is what we calculated, and we find the total investment. So this is total investment is the amount of money I'm in need to start my business. How can I go into finance? I will be able to take a loan for 3 million and a half, and the rest it will be my own capital. So it comes here that the only steps left for me it is to find the loan amortization, how we can calculate the loan because I have a loan. So I give you the formula here for calculating the installment. This project and this loan start by 3 million and a half, which is the loan I'm in needed to start my business. So what else I have? I have the number of years n equal 3. As well, I have the R equal 10%. And I have here that the years is 3, the R is 10, and I need the PV, which is the present value of the loan, which is 3 million and half, 3.5 million. So when we substitute, you will find the installment. So this is what we call it, the amount of cash I have to pay. Okay, out, cash to pay, outflow. So this is the cash I have it. So 1,407,000 and so on. So these are the total amount of the installment. How we calculate the interest? So I will take 10% of the loan, beginning of the loan, which is 350. And then I will need to find the principal. Since this installment, the installment part of it go for interest and the rest for the principal. Perfect. Part of interest and the rest of principal. This is great. So if I pay 350, what is left? So the 1,057,402, it is the principal. So this is what I paid from the original amount. So what is left for the end of loan? 2,442,000. So this is the end that I have to pay. And this is the starting point for me in the second year. I take 10% for this one, which is the beginning. And then I have the principal and then the end of loan. End of loan is 1 million. And then I pay 10%, and then it's all done in the third year where I pay all the loan for myself. So this is what we call it loan amortization, and I calculate it in order to, I have to installment. If he asks me what is the interest, so I can find it from this table, but this is basically an installment that I have to pay it each year in my pro forma. Voila, then we have the pro forma income statement. Net sales, I got it after I subtract the rejected items. COGS from the previous table, then I subtracted, I got the gross profit. Overhead is calculated from all the items before, but unfortunately in the first year it is loss and I have to pay installment. So I have a huge burden in the case of the average and the worst case scenario. But if I go for the best case scenario, okay, then I have a positive value and then I have a taxes with 22.5% from the positive. So pay attention, we never pay taxes if the business is not profitable. I pay taxes only if the business is profitable, but if I have exemption or I don't have that much of taxes, so it's sometimes in some project it is not deductible. So if it is positive, then I have to pay the taxes. If it is not positive, I don't have to pay taxes. If I have exemption, then this is my pro forma. After the pro forma income statement, we'll go for the pro forma balance sheet. It is the cash where we got it from the pre-opening. This is the cash we needed from the pre-opening expenses. Let's say here, this is the pre-opening. pre-opening. And account receivable, we calculated from the table of working capital. Inventory as well from the inventory of working capital. And here, if we add all of these items, what are these items? We add the cash, the account receivable, the total current assets, all these items. This is all when we calculate all these items is giving me the total current assets. So we add them. When we add all of these, it will give me what? It will give me the total current assets. I have machines and equipment 3.5 million. I have the depreciation, which I'm going to subtract it. Then it will give me the net fixed assets. So when I add the 3,025,000 and the 1,100,000, it will give me the 4 million, which is the total assets. I have a loan of 3.5 million. I have accounts payable from the working capital. This we add both of these two by additions of all these two. What we will have the total liability. After we had the total liability, and then I have the equity, and both of them, it will give me the total liability and equity 4,600,000. So we will compare between the assets and liabilities to holder equity. We will find we have an excess of cash. We can reinvest it in my businesses. So if I want to make a final comment on the case, I can do profitability ratio, gross profit margin, how we calculate it. We do gross profit over sales, operating profit over sales, net profit over sales. So this is a very brilliant project, and I did only this on the final situation, which is the best case scenario. Okay, if I look for this best case scenario, I have total investment, which is the 4,668,000 divided by the net profit. I will know that if I work with the best case scenario, I can have the payback period after 2.2 months for my project. If I want to find the return on assets, the assets is 3.5 million, and the net profit here is 1,900,000, so it is 57. Return on equity, this is my equity, and this is the net profit. Then I have the total return on equity. And by this, we did all the steps for making a judgment on a Egyptian fabric industry, and we said that it is profitable only in one case, when it is working with the full capacity. But if I don't have that much of sales on the average and the worst, then unfortunately I will receive a losses, as we see before. So it will not be rewarding. So it is a very competitive and risky project. It needs a lot of work to do it. Thank you. And if you enjoy it, I would like to see your comments, and I wish that you can do a very profitable and share your experience. And if there is a limitation, please put your comments. I will take it in my consideration. Thank you.